Welcome to today's Explainer. We're unpacking a really fascinating financial detective story today. Royal Bank of Canada, or RBC, just dropped their third quarter earnings, and wow, on the surface, it looks like an absolute home run for one of Canada's most dominant financial institutions. But we aren't here to just cheer for the headlines, right? We're going to figure out if RBC's incredible performance makes its stock an automatic buy at these current prices, or if the market has already priced in a little too much of this good news. And here is the headline number that immediately grabs your attention. RBC just produced a record-breaking profit of 6 billion Canadian dollars in a single quarter. Let that sink in for a second. 6 billion dollars. That represents an 11% jump year over year. It's a massive, truly extraordinary figure that shows just how powerful this bank's earnings engine really is. When you see a number like this, the immediate instinct is to assume the stock is just a screaming buy.
But hold on, because that leads us right into the central mystery of this explainer. It's the core question every investor needs to ask right now. How much of this growth can actually continue? Because as we're going to see, we really need to separate permanent, durable earnings power, the kind of structural growth you can bank on for the next decade, from unusually favorable, potentially temporary market conditions that might just be giving this specific quarter a massive tailwind.
When you look under the hood, things get super interesting. Let's look at the facts. Net income is up 11% to just over $6 billion. Diluted earnings per share, or EPS, hit $4.23, which is a 13% acceleration. But look down at the bottom row. Revenue grew by 9%, coming in around $18.5 billion. So the crucial point here is this gap. EPS is growing at 13%, but revenue is only growing at 9%. Earnings are accelerating faster than the top line. To solve our mystery, we have to figure out exactly what is creating that leverage. Section 1. Where the money originated. To figure out what pushed that EPS so high, we gotta look at how the profits were distributed. And this brings us to our first major clue, 32%. That is the staggering year-over-year net income growth generated by RBC's wealth management division alone, bringing in over $1.4 billion. Think about that for a second. The overall bank's earnings grew by 11%, but wealth management is growing nearly 3 times faster than that. It's become an absolute beast of an engine for overall profitability this quarter. But this is exactly where we have to pause and ask some tough questions. To understand this wealth management surge, let's use a restaurant analogy. Imagine a restaurant reporting record profits. Sounds amazing, right? But what if you find out half those customers only showed up because the whole city was busy with a massive one-time festival? The restaurant is still excellent, for sure, but you wouldn't bet next year's sales will automatically be just as strong once the festival packs up and leaves. According to RBC's own reporting, a lot of this wealth management growth was driven by higher fee-based client assets, which were heavily helped by market appreciation. Basically, the stock market went up. So, what happens to this massive growth engine when the broader markets actually stop rising? Which brings us to our second clue, the capital markets engine. RBC had an insanely profitable quarter here, driven by surging deal-making, underwriting, and trading revenues. Across corporate and investment banking, the activity was just exceptionally strong. But much like the stock market driving wealth management, we have to remember that capital markets are historically very cyclical. Trading and deal-making can be incredibly lucrative when conditions are perfect, but you just can't automatically extrapolate those peak conditions indefinitely into the future. Section 2. The contradicting numbers. Okay, so we've found the engines driving the record profits, and they are genuinely impressive. Yes, the bank is crushing it. But hidden underneath that shiny $6 billion headline is a metric moving in the exact opposite direction. While the bank is accelerating with an EPS jumping 13%, the total provision for credit losses jumped by 14%. RBC had to set aside a full $1 billion this quarter for bad loans. They noted this was largely due to higher provisions in capital markets and personal banking. Now, it's not a crisis. RBC is a juggernaut, but it is absolutely a number worth watching carefully. When earnings are accelerating, you generally don't want to see credit risk provisions accelerating even faster. To put this in perspective, think about building a household budget. If your family makes more money this year because of a one-time temporary bonus, that's awesome news. But you absolutely shouldn't build your permanent 10-year household budget assuming that exact bonus will show up every single year. That is the key difference between cyclical earning strength, like red-hot capital markets and rising stock markets, versus recurring, durable earnings power. We have to be really careful not to extrapolate cyclical highs while simultaneously ignoring the reality of rising credit costs. Now, I want to be crystal clear here. This is not a weak bank story. Not at all. RBC's fundamental success is undeniable. Their Common Equity Tier 1, or CET1 ratio, is sitting flat and strong at 13.5%, which is well above regulatory requirements. They have a liquidity coverage ratio of 125%, representing a massive $98 billion liquidity surplus. We are talking about a pristine balance sheet. This is a story about a remarkably strong, highly profitable bank.
And they are sharing that strength directly with investors, which we love to see. During the quarter, RBC returned a staggering $4 billion to shareholders. $2.4 billion of that went out as common dividends. They even declared a $1.76 quarterly dividend. The remaining $1.6 billion went into share buybacks. But keep in mind, buybacks are essentially the company buying its own stock. And that strategy is significantly less powerful at creating true shareholder value when the stock being purchased is already expensive.
Section 3, Bull versus Bear cases. We've seen the undeniable strength of the bank, and we've seen the potential cyclical vulnerabilities. It's time to impartially weigh the evidence, starting with the bull case. If you're optimistic about RBC, your argument is straightforward and backed by really solid data. RBC isn't just a basic lender anymore. It's a highly diversified financial services platform. It boasts a phenomenal 17.9% return on equity. You have double-digit EPS growth at 13%. And with that fortress 13.5% CET1 ratio, they have massive capital flexibility to keep investing, growing, and returning cash to shareholders. The bulls argue RBC is a dominant platform perfectly capable of producing premium earnings growth for years to come. But then we have the bear case. And notice, the bear case isn't RBC is a bad bank. Instead, the bears argue that RBC is an excellent bank, but its stock might simply be priced for perfection right now. Before these earnings, the stock closed at a hefty premium of roughly 288 Canadian dollars, or about 207 US dollars. The bears point out that those massive wealth earnings are totally vulnerable if the stock market pulls back. They argue that capital markets conditions will eventually normalize, and they point right at that credit risk, with PCL trending upward by 14%. To truly understand what investors are paying for this level of quality, look at the valuation gap. Historically, the 10-year average price-to-earnings ratio for Canadian banks sits right around 10.8 times expected earnings. But today, based on market data for RBC's U.S. listing, it's currently trading at a massive premium of 18.6 times trailing earnings. Now, that premium might be completely justified by RBC's superior diversification and that awesome 17.9% ROE today, but paying roughly 18 times earnings for a mature bank leaves very, very little room for disappointment if that double-digit growth starts to cool off. Section 4, the final verdict. We've followed the clues, we've examined the engines of growth, and we've scrutinized the price tag. It all comes down to this single, decisive question. Is a great company automatically a great stock at any price? We know that $6 billion profit is absolutely real. The balance sheet is undeniably strong. But the evidence also clearly shows us that not every single dollar of that 11% growth is equally repeatable. The market is pricing RBC as a premium quality asset, fully expecting this exceptional performance to continue without a single hitch. Which leads us to our final verdict. Watch or wait for a better price. If you're looking at this objectively, you need to monitor if the return on equity is actually sustainable relative to that sky-high valuation. You need to watch the durability of their EPS growth as we head into Q4 and definitely keep closely tracking those credit costs and PCL ratios. Because here is the provocative thought I want to leave you with today. RBC is an absolutely excellent bank, no doubt about it. But if their explosive growth normalizes back to standard levels while the stock valuation stays priced for absolute perfection, will this incredible $6 billion profit engine still leave you wanting more? Thanks for joining me on this explainer, and I'll catch you next time.